Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another episode of the What Matters podcast. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today we're thrilled to have Rob Herman joining us, a managing principal of the 4100 Group Financial Services, the parent company of Gries Financials. Welcome to the show, Rob.
Thanks very much, Mike and Ashley. It's a pleasure to be with you today.
Oh, it's a pleasure to have you with us today, Rob. With your impressive background, we're eager to explore some aspects of your journey on a more personal level today, too. So let's dive right in. Rob, let's start by exploring your journey and your unique journey in wealth management. Can you share with us your origin story and the experiences that ultimately set you on this path and led you to now your role as managing principal at 4100?
Yeah, absolutely. And it's funny that there's the old adage, life is what happens to you when you're busy making other plans. So I got out of undergrad and worked in the public and nonprofit space for a while, for about 4 years before going back to graduate school. Including work as a press secretary. As a side note, it's funny to think that 30 years ago, I felt like the parties were pretty polarized and we were far apart, but I think it's taken a whole new level in recent years. But we're not going to talk about politics today. We're going to go straight into the graduate school experience I had at Northwestern, where I really learned and got my grounding in finance and loved it. I'd been out of school for 4 years. I went to undergrad at Michigan, worked for 4 years, as I said, in the public nonprofit space, went back to graduate school and took a job cutting my teeth in management consulting, but got an offer to work as a sell-side research analyst. I had a love for the markets at Goldman Sachs. And ultimately, I ended up running a small asset management firm with a partner, but met the folks at Gries Financial Partners, led by Sally Gries. Sally was one of the pioneers in the RIA space, especially as a female, one of the first Midwest female-owned RIAs. And I had known Sally for a while and her team, including Jeff Palmer and Ed Bell, who continue to be my colleagues and partners for a long time now. And they said, bring your asset management strategy with you. We're a conflict-free shop who is fee only, which at that point was still an evolving idea. And I fell in love, to your question, Ashley, with the RIA space very quickly. And while I had been an asset manager for some time, managing equities, I realized that the broader impact of the RIA space could really make a difference in clients' lives. So that's where I started on my journey with Gries Financial Partners, and that was my foray into the RIA space as well.
Thank you. And so, you know what, if you could tell us a little bit about, the breakdown of the 4100 company there. I see that, Gries itself has around, $1 billion in AUM there. And there's some other breakup of money that's managed, I believe. I saw a few companies underneath the holding company there. Can you talk to us a bit about that?
Absolutely. So AUM and AUA, it's larger than $1 billion. We also have that proprietary asset management strategy that I'd mentioned in my predecessor company that's owned by Gries Financial Partners. It's called Logix. It's offered to clients of Gries without any additional fee to avoid conflicts of interest, but it's also offered institutionally to various platforms. So the size of the asset base is a little larger when you take into account AUM and AUA. But about 4 years ago, we were approached by the 4100 Group as a permanent capital type of vehicle. I think there's a lot of roll-ups in the space that have a different approach, and that's fine. But what we liked about the permanent capital approach is to really build something for the long haul and take a bit of a unique approach. As the subject matter experts in RIAs, 4100 agreed to give us support and also which is appreciated, and the financial wherewithal to keep moving forward, but also to continue with the existing structure of how we think an RIA and related types of entities should be run. It's been a great collaboration. So what's great about 4100 is it involves Gries Financial Partners as its anchor entity, but in addition to that, we can develop other platforms that add to what Gries is doing. For example, I mentioned the asset management piece and doing it in a conflict-free way, a multifamily office for ultra high net worth clients that has all kinds of ancillary services for the ultra high net worth state. So that also includes comprehensive financial planning. It also includes building entities that may involve accounting, like for example, tax or insurance as well. Again, the idea is to do this as kind of an ecosystem, as a platform to build a best-in-class wealth management continuum that serves not only the end client, but also other peers in our space as well. So 4100 Financial Services has been a great partner. Now, kind of building with a balance sheet and the idea of a permanent capital type of entity as opposed to a private equity type of mindset. And we're really starting to hit our stride in terms of both organic growth and also inorganic growth in the context of partnerships and M&A as well.
So talk to us about that. You guys partnered with 4100, and in building the Gries and the rest of the entity there. What's been the majority of your growth there, inorganic or organic growth?
Yeah, it's interesting. What's nice about the partnership with 4100, which happened in 2020, is permanent capital also can sometimes mean more patient capital than traditional private equity. So what they've enabled us to do is build out the Gries Financial Partners team initially in some new cities. For example, we went into some new markets, Detroit, Nashville, Kansas City, as examples. And keep in mind, our partnership with them started in the throes of the pandemic. So we knew, you talk about wanting a partner through good times and bad. We had a growth plan in place in collaboration with 4100 Group, understanding that there was some uncertainty around the pandemic and when growth would start again. What we found is that, to your question, Mike, the organic growth started pretty quickly being in those new markets. And it enabled us, we initially were primarily in Ohio and Cleveland, where we're headquartered, and Cincinnati, we had a significant presence as well. But building in those new markets and realizing organic growth from those new markets, kind of made a difference. But in addition, the organic growth built new relationships, new circles of people we could talk to about the inorganic growth piece. And that really runs the gamut. I would say, while the organic growth has been the primary pillar of what's happened over the last couple of years, with a few recent acquisitions, that's shifting, as you might expect. The inorganic growth begets organic growth and vice versa. We've done a couple of transactions now that have worked really well. And what's interesting about this space, as you both know, is that there's some really compelling smaller RIAs out there that are looking for a partner with the same mindset. And those are really a pleasure, and they're seamless from an integration perspective oftentimes. The larger ones take a little more work and there's a little more variability, but that's compelling as well. But we don't play in doing these large RIA deals. We prefer to grow at a reasonable pace. Again, not being in a situation where we have to grow to turn around and get a higher multiple for an exit. We are really seeing the ability to grow in a way that's consistent with the way we approach the space, and that's been a pleasure. So the short answer to your question, Mike, is it's shifting from organic being the primary growth driver to inorganic, but we imagine during different periods it will go in either direction depending on where we are.
Yeah, to add to that, I could say that, shifting from the organic to the inorganic growth, strategy there with the amount of advisors that are retiring, and And on top of that, more people having money these days too. And I think that with that being said, these next 10 years is going to be more people having money and more people retiring. So I think it's going to be a pretty cool time in the industry. When you highlighted on something that, it kind of hits almost where Ashley and I go every day with what our day jobs is. I apologize. It's not the podcast. It does not pay the bills. I know.
It should. You guys are pretty good at what you do, but I understand.
But if you have 500 million AUM or greater, that's like the top 5% of the industry, right?
Right.
So to think about how much money exists in that 95%, people managing 50 million, 100 million, 150 million. I could tell you, probably at this point in this stage, since we started Rise Growth, we probably had conversations with 650 to $700 billion of RIAs with, AUM within that $1.5 to $7 or $8 billion range. And there's just so very few of them. Right. And so I understand that, why you guys would go for the smaller guys and, they could utilize your help more. And I think that's a great strategy on your end.
Thanks very much, Mike. And yeah, it's interesting. So, it's a couple things to unpack with what you said, because you raised some good points. I think we've also looked more recently at some larger RIAs, and that may or may not prove to be a deal or two that comes to fruition. The smaller ones, I think there's a lot of recognition, and it's partly what you said, that the industry is consolidating. And one of the reasons that the 4100 Group is such a good partnership for Gries Financial Partners is it allows us to scale appropriately by bringing on smaller entities, not exclusively so. And as I said, it runs the gamut. Something I'd love to talk about is kind of the pillars that we see in building a broader platform from the 4100 financial services perspective, because it's not just pure wealth management. And I'd love to talk about that if you guys are interested. But you're right, because it's a scale business, the smaller shops realize, and while we weren't small, we weren't able to scale sufficiently to really become a larger player and participate in economies of scale and get access to the types of vehicles that we were looking for. What it enables us to do is add value to those smaller players. They become part of what we're doing, and they don't really miss a beat. So I think that scale piece is a really interesting dynamic, Mike, and especially in the context of the industry consolidating. There's a lot of money chasing these types of smaller advisors, but ultimately, I think for these advisors, at least in our experience, because we've talked to a lot of them over the last couple of years, it's not just about the multiple on cash flow or revenue. It's about finding a fit, whether it's just because you're retiring and you're handing off the clients to somebody and you want them to be in a good place, or you're continuing on, or you want your employees to have a good landing spot and feel like there's got to be some kind of fit. Either way, I think it's really important for those advisors to look at the broad gamut of what's available. And I think the 4100 Group, for us, the partnership has allowed us to be a player in that space, to add value to the smaller advisors and grow in the right way, so we become more meaningful in terms of size and the opportunity it presents to all of us that are working on this team.
Yeah.
And so how many total team members do you guys have now?
Well, just on the Gries side, we have 30 now, and that's up significantly from where we were. But we are also in other portfolio companies, and at the 4100 Group level, have a couple dozen other people as well that are working collaboratively on that parent company level. And it's been a great fit. We were just a couple days ago with members of both the Gries Financial Partners leadership team and the 4100 Group leadership team, brainstorming what the next couple of years look like. And it's really a pleasure to have that kind of collaboration. And, of course, the balance sheet helps, but it's really more about that fit, that personality fit, and the way you view strategic vision moving forward. Because, look, there's no black or white one way to do things, but to be on the same page in terms of client service and service intensity and the way you scale without losing that boutique feel.
Right.
There are plenty of firms that have 100 million in assets that don't have a boutique feel, and firms that have a couple billion in assets like ours that we think have maintained that. So it is about that values fit. There's no right or wrong way. I'm not saying anybody's doing something the wrong way, but the way we view it is having a collaborative partner to have those conversations and have the team members in place. As we've grown headcount, we've been lucky and fortunate to find the right people. Part of that is not luck, part of it's process. But to grow, especially in this labor environment, it's hard to find good people. We've been very fortunate in that regard.
So let me ask you another question. You know, with the amount of advisors that are going to be retiring, you know, do you guys maybe plan on buying some of those books and having, you know, a G2 in place and some of these younger cats to come in and oversee those books?
Yeah, absolutely. I mean, I think you hit on something, Mike, really important. And we see this also in the accounting space as well. It's separate from wealth management, but it's relevant in terms of high-end tax planning for the high net worth set or anybody with complicated returns. They all seem complicated these days, I think, all the returns. But the point being that you have to think about that next level down. We've got a couple of people in place, including somebody on our team based in Nashville, who is, in addition to other people on the team that are younger, that are that next level of leadership. And you have to always look out for, you know, Mike, you mentioned the younger cats. That's what we're thinking about. We're thinking about G2 and G3, and it's easy to say it, but it's harder to do it. And as evidence of that, we do see a lot of smaller shops. And it's not their fault. It's difficult to find a succession plan for a smaller shop. But what this gives, and we just did a deal in Dayton with this idea in mind, Dayton, Ohio, that fits into our geographic area, is a great guy, Dennis, who isn't ready to retire, runs the business the right way, wants to work for some period of time, but wanted that succession plan with a firm that understood what he did and how he did it and was supportive. So I think that, you know, moving forward, we've done a deal. We've acquired his practice. It's positive for him, not only financially, but also takes work off of his plate. It gives him that glide path to whenever he wants to retire, and that's what he's thinking about. On the other hand, there are younger practices that are looking for more growth and more opportunity than they can do with a couple of people. And our infrastructure, whether it be the operations team, the financial planning piece of it, the investment team, the trading team, all of that is on the shoulders of a smaller shop where they're doing 12 things at once. So that whole paradigm allows them to focus a little bit more on what they want to be doing, and everybody's different in terms of what they want to be focused on, but it allows them to grow, and we give them a path to not only having a deal where they make money on the front end of that deal, but they see, for younger people, that they see, or not so younger people, they see a path to making more money than they're making now. So it's the best of both worlds for them. But Mike, it's exactly your point. It's the older people that are looking for a path to retirement or just want to get out of the business completely. It's the younger people that realize it's a scale business and they want to grow with a sufficiently staffed and sufficiently financed partner to be able to do well as they advance in their career. And sometimes it's just making sure the retiring person looks out for the people that are still working for them. And that's a common equation. So there's always the human element of this. You got to do right by people. So you're right. And the demographics are changing in terms of the advisor space. So you need to think about who's going to be doing this, who's going to be leading this firm in 5 years, in 10 years, and in 20 years. And all of that is very much present. It's not an easy equation always, but you always have to think about staffing along those lines.
So let me ask you this. So, and you saying that there, do you think that there is there's a what's the word for it? When these guys are coming on board, are you guys doing cash, buying out in cash or giving them stock swapping there? How's that working out?
Yeah. So the way we do it, and one of the nice things about having the 4100 Group partnership for Gries Financial Partners and all being a collaborative team is we have an open forum to talk about flexibility and deal structure. Some people want more money up front. Some people are looking more at the future and how that might work out. We have the cash to be competitive, very competitive in the market and paying market multiples on cash flow or whatever the metric that the deal partner, the seller, is looking to do. So we do deals like that. Sometimes it's based on longer term for smaller businesses. Maybe it's kind of a percentage basis. It really depends on what that deal partner is looking for. And we do have incentive-based ideas. For example, the construct, broadly speaking, the idea of something like a profits interest or a synthetic vehicle for people to be able to participate in the growth of the broader firm. And we find collectively, it's not exactly an a la carte menu, but we find collectively we can put our heads together with sellers or deal partners and figure out what the most optimal way of doing it is. As I mentioned, somebody who's on the glide path to retirement might be much more interested in getting money up front over a reasonable period of time and exiting the business. But most people are looking at it a little longer term and a little more strategically than that, even if they are towards the tail end of their career. And it's nice to have a partner like the 4100 Group where we can be flexible in the way we think about deal structure and actually listen. I think one thing that we found previously when we had heard overtures as a standalone firm, Gries Financial Partners had heard overtures from other firms, is it was one size fits all. And we tend to think that, we find in the RIA space, there's so many different situations. I could tell you a lot of stories about those situations in terms of unique family circumstances, unique reasons for selling the business, things like that. You've got to be somewhat open-minded in the way you approach it within reason, so it's a win-win. Multiples have gotten higher, and we're aware of that, and open-minded on paying market multiples and being very competitive on that space. But as you mentioned, Mike, there's more than one way to deal with that, and I think we've kind of only started to scratch the surface with a myriad of deal options, and we continue to listen and learn to make sure partners feel like they're taken care of post-transaction.
Thank you.
And I'm curious,
absolutely.
In terms of those smaller shops who are looking to scale, in your experience, at what point are you seeing these shops come to you or starting to seek a partner to help them with that?
Yeah, it's interesting, Ashley, because I talked about learning as if you've met one deal partner, you've met one deal partner, right? It doesn't necessarily translate into the next one. Mm-hmm. It doesn't mean that, you've learned from one partner how to do it next time, but there are to your question, a few lessons we've learned. I'd put, there's a couple of archetypes here, and I find that generally speaking, there are people later in their career who, because of the business they're in, which is wealth management, planning, and everything else, they're pretty thoughtful in thinking ahead of time. Not always, because sometimes there's health concerns or whatever else that force somebody into a situation, and that's unfortunate. But I think when they reach a certain point in their career, someone who's maybe 3-5 years away from retirement wants to have that conversation. And so that's great for us because it's not them retiring tomorrow. It's them wanting to be a part of the conversation moving forward and taking care of those clients alongside us for some period of time and being compensated, obviously, for that. So we find that, they come to us at that stage of their careers and at that stage of the business. It's a more mature business. They have processes in place. Part of the question is we want to do right by the way they've handled their clients from a service perspective or wealth management perspective. Can we find commonality? Is there a fit in terms of approach? Are they open-minded? Are we open-minded? And we think we're pretty open-minded in how to approach clients. So actually that piece of it is they really are coming well in advance of when they have to make a decision. And so it gives us that path to figuring it out together, and it doesn't force a deal to be done in a month. It gives us plenty of time to structure the deal appropriately. But to your question, there's also the other piece of it, where we're finding more and more and we just had this conversation with a firm, so it's fresh in my mind, where they're very early in their growth cycle. And what they're finding is they've been very successful. They're doing quite well financially, but they start to realize that with scale, with people around them, infrastructure, where they don't have to handle the operational piece, they
Right.
can maybe grow 2 or 3x. There's a great book called 10x is easier than 2x.
Yeah.
And I think we've learned, not only our advisors understanding that they come to us, we've learned that as well. There's ways to create a bigger picture firm, bringing in more people and having a common values platform and a common approach. That doesn't mean it's one size fits all by any stretch, but it gives them a framework. So again, Ashley, long answer to your question, there's the more mature businesses where they come to us with sufficient time to figure it out, but also increasingly the younger businesses that are just hitting that J curve of growth, but realize that to truly optimize what they're doing, they need to come earlier to reach that scale.
And
yeah.
I was
go for it,
going to
Ashley.
ask that J, where they're hitting that J curve, in terms of average size, amount, team members, assets, what are you seeing there typically?
Yeah, in terms of where it starts and where it finishes, or at the front end of the J curve?
Where they're starting to look to scale and seek Gries.
Yeah, it's a great question, because, and again, what's fresh in my mind is an individual we spoke to who's got about $80 million of assets under management, who is starting on their own to talk to some people that they think are a good fit with them, that have similar sized assets under management for their own books. And they're trying to build something together, but realize they probably need help to build something around it. So I think, to your question, it's that sub $100 million younger advisor that's kind of interesting, where they're trying to figure out, who do I partner with? Do I do it with a larger firm? Does a roll-up make sense to me? Most of these guys are not working for brokerage firms. They're in their own independent RIAs, right, or maybe a hybrid RIA. But we have talked to some wirehouse advisors that are interesting as well. And we've even talked to insurance advisors who work with ultra high net worth audiences, and realize that there's probably a platform for them as well, instead of handing off everything and letting it go, that they can maybe be involved in this process as well. So Ashley, I think it's that sub $100 million that's pretty intriguing, where they want to be 3, 4, 500 million, but they're kind of, there's a finite amount of bandwidth as a smaller shop.
But and what about the guys at the wirehouses where you have I know we ran into an issue with an individual at a wirehouse, and I think he probably had maybe $1.5 billion in assets, I believe, and they had paid him a substantial amount of money, right? And so I remember, he had said to me, and this was a while back, and he had said, that, to get out of that, they paid him up front, and, he was going to have to give that money back, and wasn't allowed to take any clients and whatnot. And I believe he had moved from Merrill Lynch over to Goldman, I believe it was. And don't quote me on Goldman. I'm pretty sure that was who had moved over to. So in getting individuals from the wirehouses, have you ran into those challenges at all?
Yeah. It's something that's evolving for us, because we have been approached, as we've kind of built a little bit of a profile in terms of doing deals and our partnership, with 4100 Financial Services and Gries Financial Partners. More people taking notes. We've gotten more incoming calls, which is great. But you're right, Mike. It's challenging for wirehouse advisors, because the idea of this golden handcuff mentality, where you have to give money back and you're being paid a handsome amount of money to come there in the first place. There's this so-called gardening leave, where you can't really go back and solicit your clients for a period of time. It's all complicated. Now, there's some advisors that don't want to any longer be in that broker-dealer world, and are willing to do it. And in some cases, they understand what they can bring to the table and feel like over a 5-year period, even giving up that money from the broker dealer side, that it's worth it to them because they have either an established group of clients that will wait for them, or once they get past the non-solicit, non-compete piece, which of course, as we know, is changing as we speak in terms of what's allowable as a non-solicit, non-compete, if anything, and that's probably years to resolve, but that's evolving in terms of what constitutes a reasonable non-compete, non-solicit. But I think you're right, Mike. It is more complicated, but there are advisors that want to be in that independent RIA channel and want to rethink how they're doing business. But it's a difficult one for all the reasons you said. That being said, we are increasingly seeing teams that want to do it, that want to make the transition, and we're seeing it in a variety of arenas. It's not just for the wirehouses; it's a wide variety of investment shops, including single and multifamily offices, where people want to kind of evolve what they're doing and approach it somewhat differently. And they all have different reasons for wanting to do it. But I tend to agree with you, Mike. It's more challenging on the wirehouse side, but for the right advisor, it's worth it, not only in terms of the evolution of their business model and really focusing on a core group of clients, but it can be quite attractive financially if you structure the deal in the right way. And I think with a little bit of a strategic as opposed to tactical perspective, taking a longer term perspective, it can be worth it for them as well. And again, I'm biased on this, but I think probably some advisors look at it as a quality of life issue too.
Right.
Yeah.
And I apologize if you did mention this, but so these other advisors or firms that you're acquiring, are they rolling up under the Gries branding, Gries name, or are they holding their own?
Yeah, it's a good question, Ashley, and I didn't really delve into it, maybe just on the surface of it. It's both ways, and the way we view it is that there's a lot of smaller firms that want to roll into the broader name. They keep their client base. For the clients, they're generally speaking, they're working with the same advisor, but a larger team, which makes clients feel comfortable. If this solo shop or a shop with 2 people, something happens to them, that they've got a broader team approach behind them, and that works for the advisor, and they don't mind grabbing into that larger umbrella, that larger brand. Others want to retain their brand and do business as brand XYZ, and we understand the value of that too. And sometimes it's a conversation where for a couple of years they're going to stay as that brand and then eventually fold into it, or maybe it's a wait and see approach. But we're pretty flexible about that. And part of the reason we have to be flexible is not only to attract the right partners and be open-minded to it, but at this point, 4100 Financial Services has Gries as an anchor, but there are other brands as well coming on board that fit other pillars to complement the wealth management space. So regardless, there will be other brands. So we're pretty open-minded. In the Gries Financial Partners context, it's mostly using the brand, to your question, Ashley, but there's some that are doing business as, and that's just fine with us.
Gotcha. Thank you for elaborating on that.
Absolutely.
So Rob, let's talk about the future of the industry a little bit. So looking ahead, what do you see as the future of the wealth management industry? Do you see any specific trends, technologies really taking over the industry in the coming years? I mean, there's been so many technology advancements, evolving client preferences, different trends going on. What do you see to come?
Yeah, a couple things. It's a great question, and a question that in one way or another, Ashley, we think about all the time. You have to be forward thinking, just like you have to be forward thinking. I told you my origins as a portfolio manager, as an investment guy, which I still am, but that's always about what happens in 3 months, 6 months, 3 years, always thinking about it from a macro and a micro perspective. So this business is no different. You have to plan in advance. And I'd say there's 2 overriding things we think about. The first is just, I talked about scale before. The reality is, and it flows into the second point about technology. Technology is expensive, and it's increasingly so as we evolve. Best-in-class research, technology, hiring the right kinds of people, it's all expensive, and it's all making us think, and it's one of the reasons that 4100 Group has been such a great partner for us, is you need a balance sheet and growth to be able to do this well. Even as a smaller, sadly now, $2-3 billion in AUM, AUA is a smallish firm. To be able to keep that boutique feel and to have overcapacity from a service perspective and bring in the right partners, you need to have quite a significant infrastructure in place, operations, planning, ancillary services like tax and investment management, of course. All of that, which feeds off of itself in terms of attracting the right people and the right deal partners, is expensive. So you need the balance sheet behind us. And I think you don't want to grow unreasonably and indefinitely. You want to keep that bespoke boutique firm feel at Gries Financial Partners. And that's what 4100 Financial Services is all about, over servicing and intensive capacity. So that's the first trend, having that ability to scale and do it in the way that your strategic vision feels good about. But it also flows into the second point, which is something you alluded to, Ashley, which is that technology piece will change. Does it mean AI is going to take our jobs? I don't think so. I don't think that's going to come, for a whole host of reasons. I'm not sure that would be good either for the industry or more broadly. But what it does mean is it can make us more effective, more efficient across the board, operationally, planning-wise, investment-wise. It can make us better at our jobs. Again, that's expensive. It goes back to the whole idea of having the ability to scale by having a balance sheet behind you. But it also means that we can do our jobs better. And I can promise you the world's going to look very different with AI and a whole host of other technology advancements in 3 to 5 years. And we need to be cutting edge. And that's also speaking to, the diversity of demographics in terms of the clients we serve and the people that we hire to serve them, to make sure we have people that really do understand what comes next, what technology is all about. We don't want to keep doing things the same way from a process perspective. We want to keep thinking about how we can keep that boutique feel, how we can optimize risk return, how we can do sufficient planning, but do it optimally given the technology resources we have. And that will change things significantly. And I think with deal partners moving forward, part of what we're looking at is not only the right people, but thinking about how the whole is more than the sum of the parts in terms of servicing clients moving forward. And that's a complicated equation, but one we think about pretty much every day.
Thank you.
Yeah. So on the flip side of that, shifting gears a bit, any sectors or investments that really excite you right now, or you believe hold promising for the future of wealth management or wealth creation, I should say?
Yeah, absolutely. Well, first of all, we do have a pretty compelling proprietary equity strategy that is value-based. Now, growth has been on fire, but we do think this is a pretty unique dividend strategy that historically has had 80% upside capture, 60% downside capture as a track record. So certainly there's no assurance about the future, but we know the value investing space. And we think there are opportunities for the right kinds of value sectors to do well in the coming years. But beyond that, we really there's a lot of things to be concerned about, from a macro perspective. We all know what they are, this week talking about inflation and related growth. Are we concerned about stagflation of the period like the 70s? We don't, think that's a significant near-term concern, but there are, when you look at the federal deficit and what the implications are of that, all of those put together create this wall of worry. So what we've looked at holistically are, yes, you need asset allocation, you need traditional stocks and bonds. You need to go across the continuum and be creative, not only with passive management types of vehicles, but also active management. There's a lot even in the public equity and bond markets, there's a lot of ways to approach investing. We saw that last year in terms of interest rate fluctuations and how to approach things in the right way. But that also means you can go after alternative asset classes. And it's easy to use that word alternatives, but it's such a complicated space We have a chief investment officer whose name is Ken Brodkowitz. Under him is a gentleman named Chris Jaros. Ken and I have actually been friends for 30 years. He left the hedge fund world about 8 years ago, and it's been a pleasure to work with him. You never know how it's going to be to work with a close friend. We've worked together the last 8 years where he took over as chief investment officer of the firm. And what he knows coming from the hedge fund world and having been the co-head of proprietary trading at Goldman, prior to that, he knows the private investment and the alternative space. And whether you're an accredited investor, a qualified purchaser, or neither of those, we think a big differentiator for us and our portfolio companies, starting with Gries Financial Partners, is looking at arenas, to your question, Ashley, like the right kinds of private debt, secondary private equity, special situations. All of those can provide pretty unique, outsized risk return capabilities. And that's one of the ways we talk to clients. Yes, you have to do best in class financial planning, led by our team, Ed Bell, Brent Horvath, great financial planning in mind. But you also have to be unique in the way you approach risk return to be able to protect assets while growing. And the risk return paradigm now for certain kinds of private debt vehicles is awfully compelling. And that, I think, Ashley, is quite a differentiator in terms of what we do. It's not only talking about alternatives, but investing best in class alternative vehicles.
Very interesting stuff. Absolutely.
If you can elaborate, a little bit more on where you see the future of the economy, I'd love to hear your thoughts.
Yeah, sure. I am concerned about the implications for the deficit and how it's addressed in the context of interest rates and growth of the economy. And I think that will need to be addressed. That's not a political comment whatsoever. It's just a reality when you look at things, that it will at some point, given the amount of money put into the system as a result of the unfortunate circumstances around COVID, it increased inflation, it increased growth too, which is good. But now we've got, to think about how to pay that bill. So that has implications, Mike, in terms of the economy moving forward. Right now, what you saw in the past week were signs that inflation was still somewhat entrenched, but a little bit of slowing growth. Look, data points can come out next month, next week, that will change the perspective. The markets react to that every day. That's why we have public markets to vote on those kinds of things. But I think that speaks to the market, the traditional markets being somewhat range bound after a pretty healthy period of growth in those investment classes. And so I think we need to find more creative ways to generate sufficient return without taking on too much risk. So from an economic perspective, I think, again, I'm not as concerned immediate term about a recession, but there are a lot of warning signs. The yield curve continues to be something we look at that would indicate we have to be careful in the way we approach asset allocation. So I think somewhat range bound from traditional asset classes and looking beyond that to make sure that we have an opportunity to generate kind of a preserve and grow mentality for client assets.
And do you think that the markets, obviously the markets is forward looking. Do you think because it's an election year, that's why this helped the market in being up? And, what do you think? What do you think about that? I mean, or do you think that the market actually, shows signs that we should be rallying right now?
Yeah. Mike, it's interesting. It's a little bit of both. I think it's an election year. Nobody's cutting back growth plans in an election year. People want to look good for November. Look, there is, as I mentioned, there's a lot of reasons you can look at earnings and things like that. I can point to optimistic things as well, and there's certainly signs that are positive. But I think it's tricky because there are things, given the growth in the markets already, I think that we generally think the market's fairly valued now and don't see a ton of upside in the immediate term. It doesn't mean you need to, worry about a significant correction, but it does mean you need to have your eyes open in terms of what it means. So to your point, in election year, I don't think that there's anybody that's going to clamp down on growth before November. But there will be, issues, longer term secular issues with the economy inevitably, given all the spending, and we need to kind of facilitate a solution not only there but in general about what the next 3 to 5 years looks like. So I don't have immediate concerns, but I think we're somewhat range bound, and frankly that's why when you look, money markets are now paying you much more than they were a couple of years ago when it was difficult. I've had people ask, well, what's wrong with getting 5% in a money market? The reality is you can do better, but you have to be creative and you have to mitigate risk sufficiently in order to have effective asset allocation. You don't want to be out of these asset classes, but you want to have your eyes open in terms of how you approach it.
Gosh, thank you.
Very well said. Thank you for sharing those insights with us today, Rob. I think that wraps up our episode for today. It's been an absolute pleasure having you on our show. Thank you. A special thanks to our guest, Rob Herman, for joining us, sharing your insights and experiences with us. We really appreciate it.
Thank you, Ashley. Thank you, Mike. It's been a pleasure to be with you. Look forward to doing it again.
Thank you. And to all our listeners, thanks for tuning in to another episode of the What Matters podcast. Stay tuned next time for more conversations with industry insights leaders like Rob Herman. Thanks so much, everyone. Take care.